With nearly 5,000 specialists dedicated to supporting dealer financial services, Ally has the expertise to help you with your retail finance, F&I, and remarketing needs. We're all better off with an Ally. Contact your local Ally account executive to get started today. Ally, do it right.
Welcome to Daily Drive for Thursday, May 1st, 2025. I'm Hannah Letts in Detroit, in for Jamie Butters.
And I'm Kellen Walker in Las Vegas. Today on the show, GM says tariffs could have up to a $5 billion impact this year. Ford CEO Jim Farley says Trump's import duty changes don't do enough. And Mercedes is making a big investment in the U.S. amid tariffs. Plus, Jamie talks with Cox Automotive chief economist Jonathan Smoke and the company's executive analyst Aaron Keating about what we know so far about the impact of tariffs on the industry.
All we can say really about this that's been touted as a reprieve is that it's just taking a bad situation and making it slightly less worse.
Let's run through all the news you need to know to keep up in the auto industry.
General Motors is cutting its 2025 profit forecast. That's after getting some clarity and reprieve from the White House this week on automotive tariffs. GM released the new forecast 2 days after pulling a previous one issued in January that did not take into account the automotive tariffs, and after the Trump administration's tariff changes. CEO Mary Barra told shareholders in a call this morning that the company will keep up a strong dialogue with the Trump administration on its trade policies.
As you know, there are ongoing discussions with key trade partners that may also have an impact. We will continue to be nimble and disciplined and keep you updated as we know more.
The automaker expects to notch an annual adjusted core profit between $10 billion and $12.5 billion. That includes a tariff exposure of between $4 billion and $5 billion. GM's previous guidance for earnings before interest and taxes was between $13.7 billion and $15.7 billion.
CEO Jim Farley says Ford still wants lower tariffs on imported vehicle parts, but he says changes made by President Trump will benefit the automaker and its customers. Farley also wants Ford to get credit for building large numbers of vehicles in the U.S. that are shipped overseas.
We have to work with the administration and get some kind of credit because you want to manufacture more in the U.S. It's not just keeping it here, it's actually exporting as well.
Farley was speaking with reporters at Ford's Kentucky truck plant on the sidelines of an event to launch the redesigned Expedition large SUV. Farley says it's essential that the federal government enact policies that encourage vehicle exports. Ford has halted exports to China because of the higher tariffs it would now have to pay.
Meanwhile, Ford rode its employee pricing for all strategy to a 16% U.S. sales increase in April. Truck sales led the way, rising 19% year over year. Toyota's U.S. sales rose 10% last month, led by a 24% jump at Lexus. Hyundai and Kia deliveries rose sharply in April. Sales rose 19% at Hyundai and 14% at Kia. Honda says deliveries rose 18% in April. And Mazda says U.S. sales jumped 21% during the month, led by record April sales for its CX-90 crossover, which jumped 46%. As of recording time, we're still waiting on sales results from Subaru. Other major automakers release U.S. sales quarterly. You can find the latest sales results and more details at autonews.com.
As President Trump's tariffs motivate consumers to snap up new cars to dodge higher prices, they're also leading Mercedes-Benz to localize production in the U.S. The German luxury automaker says it will begin production of a new high-volume model at its sprawling Alabama assembly plant in 2027. Mercedes did not disclose the nameplate it plans to assemble in Alabama, but said it would be a core segment vehicle. According to Auto Forecast Solutions, Mercedes will build the compact GLC crossover at its plant near Tuscaloosa starting in November 2027.
And Elon Musk will likely remain Tesla's CEO for years despite tension with the board of directors that reportedly led some members to start a search for his replacement. About a month ago, Tesla board members reached out to executive search firms to find a new CEO amid falling sales, falling profits, and Musk's time commitment to the White House as an advisor. That's according to a report from the Wall Street Journal on Wednesday. At least one board member and Musk himself denied the reports on social media. Analyst Dan Ives of Wedbush Securities said in a research note that Musk and the Tesla board appeared to have resolved their issues. And those are today's headlines.
So, Hannah, I know you've been keeping an eye on tariffs. What's the latest tariff news this week? And is there any good news for suppliers?
Yeah, lots of news this week. The industry got some relief. The Trump administration said automotive tariffs that were stacking with steel and aluminum tariffs no longer combine. So only the auto part tariff would apply, for example, if a steel automotive component was imported. And that's just one piece of it. The administration also offered a partial reimbursement on parts tariffs for US assembled vehicles. So the reimbursement will last 2 years. It still is in line with the government's goal for automakers to source the vast majority of parts from the US. And there's a precise calculation behind it that you can read about at autonews.com. So the automakers and suppliers have expressed a lot of gratitude to the Trump administration for this change, but some are saying it still doesn't go far enough, especially for suppliers. It's been very much centered on automakers in the executive order, and the automakers can share the reimbursement with suppliers, but that really hasn't been spelled out.
Gotcha. And we'll hear more about the latest tariff news coming up with Cox Automotive Chief Economist Jonathan Smoke and Executive Analyst Aaron Keating. They discuss the latest tariff changes and what they mean for the industry. That's next on Daily Drive.
For over 100 years, Ally has helped dealers like you serve your customers by providing the best-in-class products and services you need, and by remaining true to the automotive passion we share. Your dedicated Ally account executive will work hand in hand with you to help you gain efficiencies, increase your product offerings, and work to improve per-vehicle revenue. Because we care about your business as much as you do. We're all better off with an Ally. Contact your local Ally account executive to get started today. Ally, do it right.
Welcome back to Daily Drive. I'm Hannah Lutz with Kellen Walker. This week, President Donald Trump announced changes to his tariff policies. He said the moves are meant to give the industry more time and flexibility to build vehicles and parts in the U.S. But industry leaders are looking for clarity on what the changes and the duties themselves mean for their businesses and products. Earlier today, our own Jamie Butters hosted a webinar for the Automotive Press Association with Cox Automotive Chief Economist Jonathan Smoke and Executive Analyst Aaron Keating. They discussed the tariff moves and their likely impact. Here's a piece of their conversation.
To draw you out just a little bit more on that, I mean, it's really interesting. You know, March was such a gangbusters month, and April started off really strong. But it's interesting what you said about the sales momentum slowing throughout the month. As the consumer confidence is falling and these other trends. I mean, I know you just cut the outlook for the full year at the end of the first quarter, but this seems like it's adding up to a scenario with some pretty bad, and we just saw first quarter GDP was negative. It seems like this is adding up to a scenario with some pretty bad implications for the rest of the year. At what point might you need to adjust your outlook again? Would it be in a month or two?
Well, we all focus on an annual number. And so part of the magic when you've had such a frenzy and strength in the first quarter and now into, April's going to be a really solid number. We just think it's going to be slightly down from what it was in March. And that sets you up to, well, if you do the math to end up at a year that we projected to be 15.6 now, that definitely implies a pretty substantial amount of slowing. That probably gets you at least into the low 14s and possibly lower than that before you get really back to what we think the natural market would be with this level of pricing and reduced production is closer to 15, maybe 15.5 at its top. So essentially, we've got to deal with the market radically adjusting from that level to below. But to your point, it also means we have to be talking about the broader effect on the economy. And so all of that talk, and yes, the forecast revision we did was for what we expect to happen, not including a recession. But if part of the mix is that the economy goes into a recession, well, then yes, there's a negative impact on vehicle demand, because when people lose their jobs, that's really when consumer spending and historically where we see the biggest decline always in vehicle purchases. I guess there is a little bit, the scenario modeling that we've done suggests that a recession probably brings sales down closer to 14 million and not worse. And it's because we've never really had a recession before when there is really low supply like we have, and a pretty substantial, I would argue, amount of pent-up demand. The problem with the pent-up demand is that it's not capable of buying any vehicle at any price. It's pent-up demand that is highly payment and price sensitive. And so as a result, with tariffs being the real driver of this, the prices are going in the wrong direction, and we don't think this environment is favorable for credit, to fix those issues. So effectively, it just means that we're stuck, with this environment.
Digging into some of the details of the executive order, or one of the two, it was interesting that one of them is tied to the MSRP, and I think one could argue that that's kind of an artificial number that automakers can set as they please. Is this open to manipulation? Can they game the system by maybe bumping up the MSRP and offering some some incentives that would counteract that, but let them capture more chargebacks, offsets?
Sure. Sure. I mean, why not? Of course they could, but OEMs to this point right now have said that they're actually not touching MSRPs and have declared, some of them have declared going into June that they're not touching the MSRPs. Ford even just said today they're not touching MSRPs on any May-built vehicles. So I think consumers are still highly sensitive to MSRPs, and I do believe that is where a lot of consumers might be looking to see evidence of tariff increases in costs, because we've been sort of coaching individuals on how to especially look at their Monroney labels to see what their content is and things like this. So I think we do have a consumer that's getting a little bit more aware of how to look at the pricing of the vehicle and the assembly of a vehicle. That said, absolutely. I mean, if, at the end of the day, the customer is sensitive to the payment amount, to what their insurance is going to be, their monthly expenditures, and not always to the grand price of the vehicle. So it could be a way that they manipulate it. It has to be an aggregate number of the vehicles that are sold in the U.S. So it does need to take into account, of course, for manufacturers that are also importing vehicles, because again, not every vehicle is actually assembled in the U.S.
Yeah, I really don't see this as a great opening for manufacturers to play games with the MSRP, because one, as Aaron was mentioning, they've been very careful, and they know that the White House and consumers alike are paying attention to what is happening with the MSRPs. But I'll also raise the issue that MSRPs at the end of the day are very key to measuring the residual, and are key to the dynamics of understanding loan to value on the vehicle and in financing, which is 80% of the transactions that occur. So when you start contemplating potentially monkeying with the MSRP, you also really bring in credit challenges and the like that I don't think manufacturers are willing to open up that bottle, that Pandora's box, to cause more problems. So I think the action is going to be this distinction that I'm trying to draw out, that, well, the MSRPs may not change, but what consumers are really paying in the short term may spike, but that's probably not going to last over the longer term. And the real action is going to be how do some of the costs get passed along? How does it relate to the decisions for model by model? And we think that action is really going to play out at the segment level.
Yeah.
Have you looked at specific models that'll be most impacted or have the biggest impact maybe on the overall market? I mean, like the RAV4 is made largely in Canada. A lot of pickups come from Mexico.
Yeah, I mean, we've seen that. Certainly, we've kept an eye on the top 5 most impacted models, and we based that on 2024 volume sales. And if we had multiplied that out, if the tariff had been applied last year, and so that was the Chevy Equinox, the Honda HR-V, Honda CR-V, Subaru Forester, and Chevy Equinox and Chevy Trax. And so those 4 models are some of, by very virtue of the fact that they were the largest volume that would have been impacted the most given their import percentages. We've actually seen sales for all of those jump up, prices being held on those, supply is going down in all 5 of those. So it's evident that, whether it's that people were pulling ahead truly because of those specific models or otherwise they just knew, like compact SUVs is another segment. Every single compact SUV will be impacted in some way from a tariff perspective. So it's across the board where there are lower and less expensive vehicles available to the consumers. Typically, they're lower and less expensive because they are manufactured outside of the US. So again, yesterday's actions don't really help a ton with those types of models. Chevy Trax coming over from Korea, and we heard from GM this morning, them speaking to that effect. So we're still going to see a real crunch on vehicles that are actually affordable, quote unquote, from an average transaction price perspective.
Speaking of average transaction prices, you have those charts were really great, but they were mostly directional, not like hyper labeled, which is useful for the size screen we're on. I'm not complaining, but we have a question from the audience. Can you share the numbers for like ATPs in January and April, and if you an outlook going forward?
Sure. I can, while we're talking, pull up what we see or have seen with the ATPs. We generally really didn't see price changes in the first quarter. Prices were relatively flat month to month, but the Kelley Blue Book average transaction price started the year at, here we go, January, 48,145. That was a decline from a peak for last year, which is usually the case in December. You've got strong demand, you've got fully represented new models driving a lot of the increases. So we'd hit 49,768 in December. We fell to 48,145 in January. We actually then saw further declines, modest declines each month in February and March, to March's number being 47,462. And that was a 0.2% change from the month before. And really what's happening at the beginning of the year is less about more discounting. Discounting's been relatively stable. It's more mix of vehicles, more lower priced vehicles have been in the transaction. And correspondingly, one of the biggest ironies that I saw in the first quarter is we saw more subprime buyers buying vehicles too, which correlates with that mix being softer in the first quarter. As I mentioned, that data also tells us that discounting was stable in the last 2 months of the year. So consumers have generally been seeing about a 4% discount relative to MSRP, and that has been going up from premiums being paid over MSRP back in 2021 to now, looks like it was sort of stabilizing last year at 4%. And then incentives have been increasing over the last several years from all-time lows back during the supply chain challenges. We had a modest decrease in incentives in March, and it was really because I think the surge and frenzy in the last 5 days of the month didn't really materially change the offers. It's really April that I would expect that number to be a big decline. So incentives were still up year over year, 5% in March in our Kelley Blue Book data, and I suspect they will be down year over year when we get the April numbers done.
You mentioned the mix by price, the demand for the more affordable vehicles kind of skewing things down. Going forward, do you anticipate that automakers will refocus and shift their production to the high cost, high MSRP vehicles to maximize, try to maximize profits by hitting at a higher price point? As Gary asked, maximize their domestic production capacity a la the COVID approach?
I mean, one of the things that's interesting is when we were looking at the dynamics of supply over the last few weeks, pickups and large SUVs are the ones that aren't dwindling in supply as much. So that would lead you to believe we've already got plenty of supply in those areas right now. It's not, those are still price sensitive, expensive vehicles. But the challenge is that those vehicles that are less expensive are the more popular and high volume vehicles that get entry into the brand, and it's highly competitive. So I can't imagine that most automakers are willing to cede share across the board by not having either the available inventory and or pricing themselves out of their competitive set. And I think that's really the dynamic we're going to continue to see play out over the next few months, is this, as I've called it, sort of a bonanza, a market share bonanza. It's just how do each of these manufacturers look across their segment and say, how do I think about competitors I typically haven't thought about, cross-shopping, and how do I promote my vehicle that might be less expensive than this other vehicle over here, especially if supply is starting to drop on those imported vehicles. And let's say you might have a domestic version or a less expensive version, or your portfolio in general is more protected and therefore you can afford to take the hit on the lower cost vehicles. So I struggle to believe that they're not going to continue to focus on the more affordable cars, whether they're able to move a lot of those here to the US or not. Assembly is certainly the easier thing to do than parts. And a lot of investments continue to come out. So it's anyone's guess. It's really going to be a manufacturer by manufacturer decision. I don't think there's going to be one solid answer across the industry.
And I'll go back to the earlier theme that I mentioned. The action's going to be at the segment level because you assess your competition at the segment level. Price elasticity is majorly different at the segment level. So what's possible to pass along and what the consumer can actually handle will be a part of that discussion, and how important that is to their global portfolio. In some cases. So that's where we're going to see the big changes, I think.
Jonathan Smoke is chief economist for Cox Automotive, and Aaron Keating is the company's executive analyst. They spoke with Jamie during an Automotive Press Association webinar today. That's Daily Drive for today. I'm Hannah Lutz, in for Jamie Butters.
And I'm Kellen Walker. Thanks to Automotive News executive producer Jake Neer, as well as our own Michael Martinez, David Phillips, Larry Valquette, Urvash Kakaria, and Lawrence Iliff for their reporting for today's podcast. You can get the latest news on tariffs, April sales results, and everything happening in the auto industry at autonews.com.
Come back tomorrow for a conversation with Tolly Williams, Fixed Operations Director at Niello Company, and Cox Automotive Director of Product Consulting, Skylar Chadwick. They talk about how to convince customers to use tax refunds for vehicle repairs and service.
Everybody's always thought about taking that tax money and going and buying and investing in a new vehicle or a used vehicle. But guess what? People are keeping their cars longer, so guess what that means? They're servicing their cars.
We'd love to hear from you. Let us know what you think of the show and the topics we covered today. Send us an email at dailydrive@autonews.com or leave us a voicemail at 313-444-2774. And if you enjoyed the podcast, remember to like, leave a review, and subscribe so you never miss an episode.